So this week I'll be going through the Chapter 4 comprehensive problem to help go through the main points in the chapter. I'm going to skip the problems that we've seen from previous chapters. For example, cash, salaries, payable. Those are the common everyday problems seen from chapters 1 to 3. I'll just focus on the problems that are new to Chapter 4. So with that said, let's look at number 5 first. Number 5 says, purchase 50 alarm systems for resale at a cost of $12,000. The alarm systems purchased an account with the terms 2, 10, and 30. What that means is you get 2% if you pay within 10 days, but the net is due in 30 days. So when you see that, at that point when the merchandise is purchased at $12,000, you have to increase an asset account. And the asset account we increase here is called merchandise inventory. So to increase an asset account, we learned from the previous chapter, we debit that. So we debit the merchandise inventory and we credit accounts payable because this was purchased an account. Now let us move our attention to number 6. In number 6, we see a return. So there was one item returned for $240. Well, when we return an item, we get our money back, right? In this case, we didn't pay with cash, so it's an accounts payable. So remember, accounts payable is a liability account. And to reduce the liability account, we have to debit it. In the same way, when we reduce accounts payable, we have less inventory. So that has to be reduced too. Inventory we talked about, it's an asset account. So that also have to be credited because to reduce an asset account, we credit that. So here, we debit the accounts payable and we credit the merchandise inventory. Now let's move our attention to number 7. Number 7 is quite interesting. So in number 7, it says install 40 alarm systems during the year for a total sale amount of $20,000. The cost of these systems amounted to $9,440. $15,000 of the sales were in accounts and $5,000 were cash sales. Well, there's a couple of interesting things going on here. First of all, I think this is the first time we're seeing that you can actually receive cash and sell and receive the cash from the rest of your sale later. So when you have two types of collection, then you have to split out how you're going to get your money. So here we see that $15,000 was an account. It wasn't paid now. They'll get the cash later. And then $5,000 was in cash. So we had to debit both accounts. So we debit accounts receivable for $15,000. We debit the cash for $5,000. And we credit the sales for $20,000. The sales were still $20,000 regardless of how we paid for it. Now something else that we have not seen before is the account called cost of goods sold. And what cost of goods sold is the expense account for merchandise inventory. You know, when we buy inventory, it's an asset. Well, once we sell it, there is no longer any future use. So it's not an asset to us anymore. So at that point, we have to recognize the expense. So we have to take it from the balance sheet statement into the income statement. And the account we're used to do that is called cost of goods sold. And this also helps us with matching. Because what happens is if we expense all our inventory when we buy it, then it looks like we made $50,000, but it cost us like $70,000 to buy the inventory. Well, really, that's not true because like $50,000 of that might still be in the warehouse. So to help us better match revenue and expenses, we don't recognize the cost of goods sold until it's sold, and that way the revenue can be matched with the expense, so our net profit can be correct, our gross profit can be correct. So it tells us in the problem that $9,440 of goods were sold. So we have to debit the cost of goods sold, increase the expense account, at the same time decrease the inventory asset account for $9,440. In number 9, the wording is a little bit confusing because the way it's worded. Let's read the question. It said, sold $26,000 of monetary services for the year. The services are billed to the customer each month. Well, on first read, it seems like they're talking about unearned revenue, but listen to what they said. They said, sold $36,000 of monetary services for the year. So in other words, at that point, the right revenue is recognized because they're making the assumption that the service has been completed, but they're billing them over time. So in that case, what we have is an accounts receivable. I don't like the wording, but that's what they're talking about. I just thought I'll mention it because of the wording is a little bit off. Number 10, pay cash on accounts payable. The payment was made before the discount period expired. At a time of purchase, the inventory had a cost of $7,920. So here it is saying, okay, when we bought this inventory, it was worth $7,920. So at that point, we had accounts payable of $7,920. And now we paid the cash in accounts payable. But then also notice what it said before the discount expired. So if the discount had not expired, are we going to pay $7,920 in cash, or would we take the discount out and keep the cash for the difference? So yes, we will take the discount out. So we take 2%, because remember it was 2% within 10 days and net 30. So we take 2% of $7,920. It gives us $158.40. And we credit merchandise inventory because it's cost us $158.40 less to get that inventory. And then we remit cash of $7,761.60. In number 11, pay cash to settle additional accounts payable. The payment was made after the discount period expired. At the time of purchase, the inventory had a cost of $2,880. Well, there's nothing really special here because we don't have to recognize any discount because the discount period has expired. So which means they're paying after 10 days. So at that point, we're going to pay the full $2,880. So we debit accounts payable for $2,880 and we credit cash for $2,880. Now, I'm not going to go through the rest of the journal entries because those are journal entries from past chapters. But what I want to show you here is how to put your journal entries side by side to your T account, because as you know, the T accounts are direct transfer from your entries. And if you have to go tab by tab, scrolling back and forth, it just makes it so hard to enter your data. One way you can make this easy is to print out the journal entry and then go in and do your T accounts. Another way to do that is do a side-by-side window like I have laid out here. And to do that, what I did here is I right-click on my T account, I moved a copy, and then I chose New Book. And then I say, okay, if you want to create a copy, you can, but I don't because I'm going to just move it right back. So here I've already done it, so I'm going to cancel that. And then when you do that, you would notice that pops out from the Excel file. And then to make it go to the side, you click your window key and right. And this only works on Windows. I don't know the Apple equivalent, so you might have to Google that. And then Windows key and left for the other screen, so that way you can see your screen side by side like this. Now to move it back, when you're done, you do move or copy back to the workbook, move it to the location you want it, so which is right after journal entries, and click OK, and then it goes back. So you make sure you save too, so that way you can make sure your work is saving, so you're not doing a whole bunch of work and you lose your work without saving it. So once you have your work side by side, it becomes very easy to go through the T accounts looking at the journal entry. So number one, we see we have a debit of salaries payable of $1,000 and we have a credit cash for $1,000. So we'll go to the salaries payable. We know it's going to be under liabilities. So we go there, it's a debit. So we put 1,000, and then we credit the cash. So 1,001. We keep going, so now number 2, it says debit cash for $42,000, so we see 42,000, and then we move to the common stock, and it says credit common stock for 42,000 to 42,000. One thing I should mention here is before you actually start going through the journal entries is you should probably go through your beginning trial balance and fill in all the beginning balances so you don't forget to do that. So all of these are the beginning balance that came from the problem. So that way at the end, your balance is correct. And the same thing, number 3 says debit prepaid cash, 6,000, credit cash 6,000. So those are both asset accounts. So I look at my prepaid rent. My prepaid rent, I debit 6,000, and I credit cash for 6,000. So number 3, 6,000. So I just keep going down and doing that until I'm done with all my journal entries. This is a faster way to complete your T accounts. Once I'm done with the T accounts, I want to go to the trial balance to make sure my debits equal credits. I know this seems like a very tedious process, but you have to remember back in the days they didn't have computers, so they had to do this checks and balances to balance the books. So a lot of this tasks are really building on other tasks to make sure that there is no there's as little error as possible. Because imagine if you're handling thousands of transactions, how easy it is to miss something. So it's basically you like accountants, like a lot of check your work and check your work. Now today, if you were doing this today, a lot of this is done by the computer. Thank God. We don't have to go through this process of manually doing our journal entries at the end of a business day. Then you give the entries to the accountant who does your T accounts, and then your trial balance. All of this was done by hand. I don't know how they did it, but they did. So even though today we don't have to use hand to do this process, it's important to understand how it works, because if your job includes like bookkeeping or accounting and there's an error in the books, knowing how it works in the background is it's the best way to help you discover what the problem possibly could be. So if you're doing data entry like your bookkeeping, accounts receivable, payable, but you don't understand the accounting concepts behind it, when something goes wrong, it's very hard for you to catch it because you don't understand the accounting behind the numbers. So I still do recommend you learn this, even though you're not going to probably do this by hand in the real world. So here, the easiest way to do this is to link all your work together. So if your work does not match and you make a change in one place, everything changes. So what I do here is I take my balances for my T accounts, which is where the numbers come from. So I go to each T account. So my cash balance, I do the equal sign. I write my equal sign and I select it. So that way that balance goes there. So if something is wrong with my cash account and I have to change one transaction, my trial balance will automatically change. I don't have to worry about going through every single statement. I do the same thing for account receivable. I go to my accounts receivable. I go scroll down, 20,500, get the balance. So I just keep going down the same way. Make sure you put the debits in the debits and the credits in the credits. And at the end of the day, when you're done, the totals have to equal. So debits have to equal credit. If it's not, you've done something wrong. And do not use a calculator. I see students doing that. This is Excel. Excel can calculate. Use the sum form. So if I do equal sum, I can add up every single thing in that column. Instead of using a calculator and coming back here, that just takes too much time. And then add it up that way. Once I'm done with my T accounts, the next thing I want to work with is my income statement. So with my income statement, the template has been given to you. So you have in this problem, we have 3 types of revenue. We have security service revenue, we have monitoring service revenue, we have alarm sales. The best way to do it again is to use your equal sign. And we want to get this number from the trial balance. So we do the equal, we go to the trial balance, security service revenue, and we look for that. We select the number we're looking for. We do enter, and that number transfers here. So that way, if I make a mistake in one place and I correct that mistake, everything in my workbook is corrected because they're all connected. You don't want to be doing double work. And remember, in your exam, you'll be turning in an Excel file. So you have to learn how to use the software. You do the same thing for monetary and service revenue. You do equal sign. You do go to your trial balance, select that. It's in there. And then you just go through every single thing. Do the same for advertising revenue. Do the same for supplies. And then you add your totals. And then you subtract to get your net income. So it just makes life so much easier because now when something changes in one place, everything else has changed. Once we're done with the income statement, we come to the statement of changes in stockholders' equity. Now to get for our numbers, the numbers we need from our statement of changes in stockholders' equity come from two places. They come from both the T account and they come from the income statement. Now, for the beginning common stock, I will have to go to my T account to get the beginning balance. So in my T account, I go to there and I choose the $8,000, the beginning balance. The $42,000, I go back to my T account to get that amount. So I have the $42,000. To get the $50,000, I add the $8,000 plus $42,000. My beginning retained earnings, I also go to my T account to get that number, $11,220. My net income I get from my income statement, $39,990. My dividends paid I get from my T account. So this one I put the minus sign because it's going to be negative. So I go back to my T account and I get that number, the $12,000. I add the $11,220 to the $39,990 and deduct the $12,000 to get my $39,210. And to get my total stockholders' equity, I add the $50,000 to the $39,210. Next, we come to the balance sheet statement. Now, the numbers that come, now where I get my numbers from the statement comes from two places. Part of it comes from my trial balance, and part of it comes from my statement of changes in equity. Now, the assets and my liabilities I get from my trial balance, and then my equity I get from my statement of changes in stockholders' equity. So to get my cash balance, make sure you use the equal sign again. Don't write. Just transfer your numbers. Go to the trial balance, select the cash balance, just do everything all the way down through. Do the same thing for assets and liabilities, and then when it comes to equity, go to your statement of changes in equity, do the equal sign, select the ending common stock, do the same thing for retained earnings, select the ending retained earnings. Now when you're done, your asset, liabilities, and stockholders' equity, the sum of those two has to also equal your total assets. If assets does not equal liabilities plus equity, then you've done something wrong. Next, I go to my cash flow. Now, to do my cash flow, remember, cash flow just deals with cash. The easiest way to deal with cash flow is to go to T accounts, copy your cash, copy it, right-click, copy, go back to cash flow, go on the bottom, and paste it right here, right-click, and then paste. And then once you're done with that, you want to go in to each transaction and classify them as operating, investing, or financing. So you go to number one, OA, and you do that all the way through FA. So we see most of them are operating, and then we have to financing. Well, the easy thing about the T accounts is we know the transactions, the operating transactions on the left side will be revenue received, and the operating activities on the right side will be expenses. So basically, to get your cash received from revenue, you just add up your revenue from your right side. So I have three of them, 5,000 plus 43,000 plus 3,000. So my revenue from operating will be $51,000. So that's what goes in here. So with my expenses, I know all of this operating here. I just sum all of it. Will all be expenses. So I have $30,642. Well, that's rounded up. So that's what goes here. And then I get my net cash flow from operating, $51,000 minus the $30,641. I get $20,358.40. In this problem, we have no investing. And then $42,000 cash issued from common stock was number 2. And then we had a cash paid for dividends, number 16. So let's see that. That's what is here. Get the net, $30,000. Net increase in cash is a $20,358 plus $30,000. Add your beginning balance of $12,500, which is right here. And then the $50,358 plus $12,500 gives you your ending cash balance, $62,858. Now this amount must equal this amount. If that doesn't equal, you've done something wrong. Now, the cash flow statement will be one that is not completely connected with the rest. So when you make a change somewhere else, you probably want to come here and see where you should make a change to. One thing you can do is to link your trial balance. If you were to link your trial, if you were to link, your T account to the trial to your original one, that way when something is changed there, it changes here, and then you just use your sum to this, then that makes everything connected. But if you don't do it that way, you have to make sure you come here to make a change. Now we come to the statement of cash flows. The easiest way to do the statement of cash flows is to go to your T accounts, copy and paste the cash T account. So right click, copy that, come back to your cash flow, and then right click and paste. I've already done it here so you can see it. Then you want to go through each question and reference them with a text and classify each transaction as OA, IA, or FA. Once you're done, since OA is always going to be the one with the most transactions, I recommend you highlight all OA so you can see. And OA is very easy because anything on the left side is going to be revenue and anything on the right side is going to be expenses. So for this, we're just going to sum up all our revenue on the right side. It's highlighted so it's easy for us to see. And we'll sum all our expenses on the left side. So we entered these two balances, $51,000 for cash collected from revenue and $30,641 for cash paid for expenses. So that's what goes here. The net cash flow is the $51,000 minus $30,641 gives us the net cash flow. Once we're done entering that, we go back. We look, there's no IA, so we skip that. We go to FA. On the right side is going to be income. So the cash from common stock is a $42,000. That goes here. And then cash paid for dividends is $12,000. So that goes here. So the net cash from financing is $30,000. So the net increase in cash is $20,358 plus $30,000 gives us the $50,358. Then you subtract your beginning cash balance of $12,500, which is that number right there. Not subtracted. You add the $12,500 to give you an ending cash balance of $62,858. Now this amount has to equal the ending cash balance. If not, you've done something wrong. Next, you have the closing entries, and then so basically you are just doing your journal entries to close the revenue, expense, and dividend account. So we know that revenue has a credit balance, so to close it, we have to debit it. So we close all our revenue accounts by debiting that, and then we credit retained earnings. The best way to do this is to link this to your trial balance. So that way, if anything changes there, this changes too. And then to use a sum function to add this so that your credit to retained earnings is connected. So that way, when one thing changes in one place, it changes here too. Same with your expense account. It has a natural debit balance. So when you close in, you credit into retained earnings. And then you close dividends to retain earnings too. So next we come to the closing T accounts. There are a couple of ways you can get your closing trial balance without the closing T account. And a lot of times I do skip this process in the exam just because I think it's redundant. I mean, if you know how to do the T account, I'm not going to ask you to come back and do it in the closing T account. So here what we're doing is you start out, you just put all your ending balances for your assets and liability accounts and common stock, and then retain earnings. You want to show where you closed your account. So here, where you close the dividends, where you close the expenses, where you close the revenue. So you're just showing that. And then you're showing all your expenses and revenue are zero by showing you're closing them. So here we show the credit that we closed it, so the balance is zero. The same thing for revenue. We closed it on the end. So we're just showing that our balances are zero. Like I said, this is not one I commonly test as far as the trial T accounts go. I mean, I do test the closing journal entries and the closing trial balance, but I believe you can get to the closing trial balance without this process. So I think it's just redundant if I had to test it. Lastly, we come to the post-closing trial balance. And here it's just basically all your balances. The idea is to take this from the closing T accounts. But like I said, if I'm not testing it, then obviously you're not going to have a closing T account on the exam. So I'll show you how to do it with a closing T account, and I'll show you how to do it another way. So here you go to the closing T account, you with your equal sign, go to each balance, and and then you just populate your closing T trial balance. Another way to do that is you can go to your trial balance and your balance sheet statement. So you go to the trial balance to get all of these accounts, everything but retained earnings, because they're not going to change. So go to your old trial balance and then get all of those accounts. And then for retained earnings, it's just going to be the balance on your balance sheet statement to get that account. And at the end of the day, this has to equal your balance sheet account. So this has to be assets. Your assets equals liabilities plus equity has to equal that. So 91,670 has to be the same thing as this 91,670.